and you are about to go down the rabbit hole and you don't even know it yet. Hey, it's Matthew Decker with Wealth Architects Radio. I'm super excited to be doing this short video series on Index Universal Life, mainly because Index Universal Life is so misunderstood. It's positioned wrong a majority of the time. There are tons of people out there that say it's the worst thing in the world, and there are tons of advisors out there that preach this as being the solution to every single problem that you could ever encounter. Neither of those things are true. So what we're going to do is we're going to break down Index Universal Life into three main categories. Now, of course, there are way more than three categories. There's so much more that we could talk about, but I want to keep this short. I want to keep this really simple, and I want to make sure that you're able to completely digest this information. If you can understand these three things about Index Universal Life, you're going to know more than 99% of the people out there, agents included. The three things that we're going to break this presentation into are as follows. Number one, we're going to be talking about crediting, and that's what this video is going to focus on. Then there's going to be two more videos that follow this. So number one will be crediting. Number two is going to be fees, an in-depth breakdown on the fees. And then number three, we're also going to be talking about how you get access to your money. So let's dig in real quick. Again, this is video one. Let's talk about crediting. So it's important to understand the basic mechanics when it comes to crediting and how your policy actually earns interest. So the first thing that you have to understand is that there is a cap on just about every single one of these policies. And what a cap means is it is the most that you're going to be able to earn in interest in any given year. And again, I'm oversimplifying, but just stick with me. If I can make it simple, if you can understand the oversimplification, you can understand all the different nuances that come along with it. So the cap is the most that you're going to be able to make in any given year. And as you can see here, we're just using 10%. It's an example. It's different with every single product. But just for this scenario, let's just say that the most you can make in any given year is 10%. You're also going to receive a floor. Now, the floor in just about 99% of the cases is going to be 0%, meaning the worst that you can do in any given year is not make money. You're not going to lose money, but you're not going to make money. 0% is your floor. The most popular form of crediting on these policies is what's called an annual point-to-point. Okay, so how does an annual point-to-point work? Very simple. You look at the starting value of your contract, and let's say that the starting value is $1,000. The only other value that matters for you to earn interest that particular year is the ending value of your index. So let's say that you're tracking along with the S&P 500. It's a popular index on these policies. A lot of people use the S&P 500. If the starting value is 1,000, and the ending value is 1,100, well, guess what you just did? You just capped out in that 1 year and earned 10%. Now, every single year, you start back over. So your new starting value, beginning in year two, is going to be 1,100. If you end at 1,100, or if you end at 900, or 800, or 700, it doesn't matter. The worst that you can do is 0%. That's your floor. So if in year one, you cap out at 10%, whatever you've earned is locked in. If in year two, the S&P is down 20%, the worst that you can do is 0 in that 1 year, and then you start all over again. Again, this is an extreme oversimplification, but if you can understand these mechanics, you can understand just about any product that's out there. So let's make it a little more real. Let's look at an actual chart with a starting value of $100,000. And we're going to go out 6 years. And we're going to compare just a regular stock, mutual fund, bond portfolio, something that can make and lose money. And we're going to compare that to something like an indexed UL policy that has a cap on it. So if your starting value is $100,000, and let's say after year one, you have a huge gain in the stock market, something like a 30% gain. Well, your stock value is going to be up 30%, so 130,000. Your index UL is not going to be up 30% more than likely because, again, there's that cap. Let's say in this instance, the cap is 12.5%. So at the end of the first year, your stock value is up at $130,000, and that orange line, your IUL policy, has gained 12.5%. Now, again, we start over every single year. So whatever you've gained is locked in the life insurance contract. And they're going to look at your starting value and your ending value. Now, let's say that the S&P in year 2 is negative. Let's say it's down 20%. So up 30 year 1, down 20% in year 2. Your stock value plummets. Your IUL stays exactly the same. Remember, you've got that 0% floor. When looking at the orange line, you're either going up or you're staying the same. You're not going to go up as high as the stock value, but you're going to go up or stay the same. Let's look at a year where the S&P is up 12.5%. Well, you're going to have the exact same growth in both the stock value and your life insurance contract. And again, your gains are always locked in. So if the stock value drops again in year 6, your life insurance contract stays the same. Your stock value, your mutual fund value, whatever else it is going to lose money. I know that I'm oversimplifying this, but you have to understand the basics in order to move into some of the more complex products that are out there. So let's do one more thing. Let's look at an actual life insurance policy contract, and let's look at some of the returns for the last 25 years. Now you can see here that there are tons of different options on this chart. I want to make it real easy and just focus on the numbers on the left that I've highlighted there. So this is an S&P index. That middle column, actual historical index change, that is the change in the S&P index for those years listed. The column on the right, annual point to point, that means how much did the policy gain subject to the cap. Now you can see here, if you look at 1995, the S&P was up 34%. This policy was only up 12.25%. Why is that? Well, you know why it is. Because there's a cap. And obviously in this case, the cap is 12.25%. So this policy capped out 5 years in a row. 1, 2, 3, 4, 5. After those 5 years of capping out, the stock market had 3 years of negative returns, -10, -13, -23. So what happened in all 3 of those years? Well, you know what happened in all 3 of those years. Nothing. 0%, 0%, 0%. Back up in 2003, up 26%. What happened? Did you get 26? No, of course not. There's a cap. What's the cap? In this instance, it's 12.25. So you can see that if you average this out, all the zeros, all the years where you cap out, in the years where you don't cap out, if the S&P is up 4.46, you get 4.46. If it's up 7.06, you get 7.06. On and on and on. Anything under the cap, you capture whatever that growth was. If it's above the cap, you get the cap. If it's below the cap, if it's below the floor, you get the floor, which in this case is 0. If you average that out over 25 years, you're talking about an annual average rate of return of 7.17%. You did that without any market risk. Okay, so that's how these policies are going to credit you interest. Every single year, you're going to track some kind of index. Oftentimes it's the S&P, but it doesn't have to be. It could be something else. Oftentimes it's the S&P. So what are you doing? You're trading your unlimited upside potential in the stock market for a limited downside potential. And in this case, no downside potential. Let me say that again. You are trading your unlimited potential for gains in the stock market. The stock market could be up 200%. Well, you are giving that up. You're saying, look, I'm not going to earn 200%. I'm going to cap myself at 12 or 13 or 10. And since I'm going to cap my upside, this life insurance company is going to come in and say, well, if you're willing to accept an upside cap, we're willing to give you a 0% floor. Now, I want to caution you. I've said it a few times. I'm going to say it again. I'm oversimplifying this. There are a lot of really bad advisors out there that sell this product as a panacea. It is not a panacea. There is a downside to this product. A lot of it has to do with how it's structured by your financial advisor or your insurance agent or whoever it is that you're working with. They have the ability to mess this up. In fact, this is one of the more abused products that are out there because it's so attractive in how you can market it. Zero's your hero, no downside risk. It's an elevator without a down button. It's attractive in how you can market it, and so it lends itself to being abused. So that's crediting with an index universal life insurance contract. I hope that you understand it. I hope that I was able to really boil that down, crystallize it for you. I know I oversimplified it, but I promise you that if you can understand just that really simple concept of how these policies credit interest, you're way ahead of the game. Make sure you stick around for the other 2 videos on fees and on access to your money. Those 2 things are just as important as how you actually earn interest in these contracts. And if you're worried about whoever it is that you're talking to, if you think that maybe you've come in contact with a bad advisor, I encourage you to actually check out the link below in the description, or you can check it out on this video here. I actually wrote a short ebook on bad advisors, how you can spot them from a mile away. If you think that you're working with a bad advisor, if you want to make sure that you never work with a bad advisor, click on that link. You can download that for free. I encourage you to read it. It's really short, simple, and I think that you'll find it valuable. Again, this is Matt Decker with Wealth Architects Radio, and I'll see you again soon.